And good evening. Welcome to our autumn budget webinar. We're just going to wait for a few minutes to let some more people join, and then we'll be looking at what happened yesterday. I say what happened yesterday. Actually, before we start, we could just have a word about the process of getting to this budget. So I'm not party political. I treat all politicians with the same amount of respect. And what we've seen in the last couple of budgets is chancellors flying kites. So they propose an idea and they wait and see how the city reacts and other people react. And then they decide whether or not it's good policy or not. And that's not really the right approach. We don't really want to have chancellors who do that. We need to have chancellors who have their own mind and their own ideas. So what we had yesterday, and what we'll be talking about shortly, is a kind of a summation of all those little things. I did sort of read before the budget that the worst thing we could have was lots of little bits rather than, say, a general increase in the rate of income tax. And I think probably that's what we've got. But that's just a personal kind of fill-in before we start the budget webinar properly. So I think we'll wait one more minute and then I'll start. All right, I think we'll make a start. So I would like to welcome everyone to our 2025 Ramsay Brown budget webinar. We are a niche practice, if you don't know who we are already, specialising in healthcare, specialising GPs, consultants, other healthcare professionals. We act for around 2,300 GPs and consultants, around 300 GP practices, around 100 plus PCNs, based in North London and looking after our clients from all over the country. In terms of size, people have the impression we're a large practice. We're about the size of a typical GP practice. So, and we look after our clients centrally from one location. So let's move on. So this is me, Laurence Slavin, known as Laurie. I've been a partner since the age of 26, dealing with healthcare, dealing with GPs, consultants, as I say before. I've seen everything at least twice, which means that in my career I've learned a lot. I've been an advisor to the NHS Management Executive for 10 years. I've sat on committees for the Department of Health and the BMA, an expert witness in GP partnership disputes, not a lot of fun. Written a book on GP accounts, very popular in Russia, apparently. And most importantly, of course, is I'm married to a GP. So let's make a start and let's look at the budget. So the objectives of this webinar, we're going to understand what the autumn budget meant for you, the key risks that you should prepare for, some practical tips that we'll go through as we go through this. You'll get our interpretation of how this is going to affect you, and at the end, or rather during the course of this webinar, you will have the opportunity to ask questions. This session is being recorded. Your cameras and microphones are off. Please use the Q&A box throughout, and the slides and replay will be shared afterwards. And we'll wrap up with a live Q&A session. So perhaps it's worth mentioning, how does a budget work? What actually happens? So on the day of the budget, the Chancellor announces her proposals, as we heard yesterday. When she sits down, by the way, all the official paperwork gets released, except for yesterday when the OBR released it early. But normally, all the paperwork gets released as the Chancellor sits down. MPs vote on a single motion to approve some tax changes that take place at midnight that day. So sometimes when you see that tax changes happen at midnight, just to stop you doing anything that you might do to help your tax or to affect the price of beer, that's what happens then. And then after that, the bill, the finance bill as it's called, works its way through Parliament just like any other bill until it becomes an act. So just a couple of kind of comments I'm making here. Don't act too hastily when you read things that are in the finance bill or you hear the Chancellor speak, because they may not end up in the final Finance Act. They may get weeded out as the bill works its way through Parliament. And the other thing to mention is you only hear a small part of the finance bill when the Chancellor speaks. So when Rachel Reeves delivered her spiel yesterday, as I said, when she sat down, the paperwork got released, and I went through 194 pages of changes, and I've worked through them, and I'm going to talk about those that I think are most relevant to you. So there'll be things in here probably that you weren't aware of. So one of the most interesting things is that they're introducing a reward scheme for informants who provide valuable information which allows HMRC to tackle high-value avoidance or evasion modelled on the US system. So if you can provide sufficient information, and if the HMRC can recover more than £1.5 million, they'll give you up to 30% of the additional tax collected. So I'm not sure this is such a good idea, really. Are we a nation of good citizens or snitches? Somebody might ask a question, is that 30% taxable if you make that money? I think the answer to that would be, well, if you're doing this as a business, it might be, but if you've just done this as a good citizen, it would probably be tax-free, which may be not such a bad thing to look at. In no particular order, but I think this is actually really important. So this is what they call the mansion tax. So from 2028, so for a few years' time, if your residential property is worth more than £2 million, or has a value of more than £2 million in 2026, you will have an additional charge that will be paid as with your council tax. It's the homeowner, not the occupier, liable for the charge, so not the people renting, but the people who own it. And the Valuation Office will conduct the valuations. The Valuation Office is an executive department of HMRC, so it's all within the same office. And there'll be revaluations every 5 years. If your property is worth between 2 million and 2.5, they will charge you £2,500. And this goes up, and this goes up, and this goes up. So what do I think about this? I think this is potentially a discriminatory charge. So I was going to talk to you about a lady client I used to have, Mrs. C, we'll call her just to preserve her name. She was married to a GP, and they had a nice flat in St John's Wood. He died young, leaving her with a small pension and a small amount of investments. And she could pay her bills as she made her way. But this would be a significant increase in her costs at £2,500. She has around £30,000 worth of savings. So to find another £2,500 to this is equivalent to an increased tax charge on her savings of 8.3%. And as you'll see a little later on with the other changes to savings tax, that's another 2%, so about another 10.3% tax she would effectively have to pay. She doesn't want to move, and indeed, why should she? But this will actually put her into some sort of difficulties. So it's quite discriminatory, I think, because actually if you're a billionaire and you're buying a house for 20 million, you don't care about the £7,500. It means nothing to you. But there we are. And the other thing I worry about when I see things like this is it's usual, or it's uncommon, for new taxes to be abolished. So we're establishing a new tax here. And will another government, will another administration change this? Well, if it's delivering a lot of revenue, then they probably won't, because it's probably worth having. There we are. Making tax digital. You'll have heard us talking about making tax digital. If you don't know about making tax digital, you will do. So this is really for those people who've got investment income or who've got, you probably just noticed the lights went out in this room where I am, but that's because no one's moved for a very long time. I'm going to carry on talking while the lights are turned back on. So making tax digital is a new regime that comes in next April. It comes in next April if you have rental income or you have self-employed income, but not partnership income of more than £50,000, then you have to register for Making Tax Digital. You will be registered for Making Tax Digital, and you have to submit quarterly returns. There's no tax payable with this, but it is going to be onerous. And thank goodness, what HMRC have said yesterday in the budget submissions is there are no late submission penalties for the first year, which is a relief. Most people that I talk to who understand how this works think there'll be chaos in the first year. So that's a good thing. There will be penalties afterwards from April 27, and those penalties will be increased. And something else they wrote about, they said there'll be, this was actually in the budget press release yesterday, there's special treatment for small taxpayer groups, but don't get excited. It's for very small taxpayer groups. They'll be exempted from MTD. When I try to find out what very small groups are, it's people like foster parents, foster carers, and other people who may have some additional income but will be exempted from this. So it's not terribly exciting, but it's really good news that the MTD penalties for late submissions are not going to apply next year. Of course, the big news that everyone's been talking about is the fact that income tax thresholds are being frozen. The bands are being frozen, and personal allowances being frozen, NIC thresholds being frozen, which means that more and more people get brought into tax at the higher rates. Back in 2021, only 15% of the population paid higher rates of tax. By 2030, that'll be 24% of the population who are paying higher rates of tax. We are living in a high tax society, as I find out with my clients on a daily basis. There's some other changes to income tax. There's a change in the taxation of property, savings and dividends. I'm going to cover those separately. The student loan repayment threshold remains the same until 2030, which means you will be paying more. Salary sacrifice for pension contribution. So this again was big news. Probably won't affect our clients too much, to be honest. But in the past, or well, until this, if you reduced your salary and made a contribution into your pension, then both the employee and the employer were better off because you paid less national insurance. But now they're limiting the amount that you can sacrifice to just £2,000. Now, the other thing they said, the government is going to take steps to ensure income tax self-assessments pay tax automatically via regular payments throughout the year. So they're looking to increase the amount of payments that you make through PAYE on income other than just your employment income. This is from April 2029. We're not quite sure how that's going to work, but again, this is all in the small print that you don't get told when the Chancellor makes her speech. Voluntary national insurance contributions for those abroad will be limited. At the moment, if you're a GP and you go and work in Australia or you go and work abroad, you can maintain your national insurance contributions for your state pension by paying Class 3 Class 3 national insurance contributions. They're going to make that more difficult. And there is, you have to prove a 10-year initial residency before you'll be able to do that. A few other things in income tax, venture capital trusts and enterprise investment schemes. They've doubled the amounts that are available and the sizes of the entities that would qualify, but they are reducing the income tax relief up front from 30% to 20%. Again, that's not expected to affect that many of our clients, but some of them. So this was interesting. They are introducing a new criminal offence of recklessness. So I looked up recklessness because I thought, well, what is recklessness? So recklessness sits between negligence, and fraud. So a negligent act is the failure to exercise the level of care that a reasonably prudent person would exercise. Fraud, on the other hand, is a deliberate intent to deceive or plan to gain something dishonestly. Recklessness is a conscious and unjustifiable disregard of a substantial and unjustifiable risk that a person's conduct will cause harm. So if you kind of knew you should look at something and didn't, that would be reckless. Negligence is a civil offence, fraud is a criminal offence, and negligence is a civil offence. I think I said that. Fraud is criminal, and recklessness sits somewhere between the two. So we're getting the message here. They're looking at doing what they can to be more penal. They are removing the deduction from income tax for non-reimbursed home working expense from April 26. I think it's a bit mean, really, but there you are. And there were some changes to ISAs, not particularly exciting, really. The annual cash limit will be set at 12,000 within the 20,000 pound ISA, unless you're age 65 or over, and then you can have a completely cash ISA. So here were some sort of meaty changes. So savings tax. They're increasing income tax on your savings by 2%. If you're a basic rate taxpayer, it goes up to 22%. If you're a high rate taxpayer, it goes up to 42%. And if you are an additional rate taxpayer, the 45% goes up to 47%. So just a comment at the bottom there. Okay, well, that's how that is, but maybe it's better to invest for capital gains than it is for income. Capital gains tax, remember, still 24%. So a lot less than income tax. How can you do that? Well, you can invest in assets that have no income and just have gains at the end of them. Different investments, property. There are things you could do. You might be advised not to put all your money into income-bearing savings. Property tax. So this is all new. And property tax, they make great lengths to say that there will be a separate regime for property tax. So basic rates taxpayers will pay 22% on the profits in their property. Higher rates 42%. The additional rate will be 47%. And if you've got mortgage interest, finance costs, it will be restricted to 22% tax relief. But just a couple of actual planning points here. So if you're a GP and if you are in receipt of notional rent or cost rent, those of us remember what that was, then you can actually choose, if you're in practice, to either get it as part of your profit share or to get it paid to you as rent. And if it's a profit share, you will not suffer the 2% uplift. So it might be worth discussing that. If you're one of our clients, then we'll talk you through it anyway. But if you're not one of our clients, you should talk to your accountant about that. If you're not one of our clients, then you can be. One other thing that's worth mentioning here is, and we worked on this with one of my clients in the last 2 weeks who were fearful about changes in capital gains tax relief, whether it's worth moving the properties that they own, the investment properties, into a company. And I'm going to talk a little bit about something called family investment companies in a moment. But if you transfer the properties into the company, then ostensibly you've got a capital gains tax and you've got stamp duty on doing that. But once the properties are in the company, they will pay tax at corporation tax rates, which start at 19%, a lot less than 47%. There's something, so you've got to weigh up whether it's worth doing. For this particular client, when we did this, it's definitely worth doing. It was definitely worth doing. There's something called Section 162 Corporation Relief that I was looking at, which allows you to transfer the properties into a company and defer the capital gains tax. Now, what that means is that you don't avoid the capital gains tax, but the tax that you would have paid, or the gain, I should say, the gain that you've made gets rolled into the value of the shares when you've acquired the company, when you set the company up. So your companies are worth those shares are worth significantly less, or the cost of those shares is significantly less because they've suffered the deduction for the capital gain that you've made. Now, it only works for businesses. So you would have to have have had your property business treated as the lights have just come back on. You've probably just noticed that. That's good. I'm sure that wasn't anything to do with Rachel Reeves. So what happens is that I lost my train of thought there. So once it's in the Section 162 relief, it defers the gain into the share values that go into the company. But you have to have your property business treated as a business now. So if you've got, what would define it as a business rather than just having a series of investments? Well, it's a grey line. It's not clear which it would be. Different commentators say different things. One well-known commentator thought you had to have at least 5 properties and you need to be running it as a business, and then you could probably claim the 162 incorporation relief. If you've just got 1 or 2 properties, then almost certainly not. And the other question is, do you want to do that? Because if you transferred the properties now, you would be paying capital gains tax at 24%. Perhaps you think that's not a bad rate of capital gains tax to pay. Who knows what those rates of tax might be in the future. So just things to think about. But I thought it was worth mentioning as we're facing this increase in property tax. And the companies that we are kind of talking about, these are generally known as family investment companies, and they've become a workable alternative to trusts. As I said before, you have to pay capital gains tax on the transfer of the assets, on the assets transferred, market value before you ask. The company then pays corporation tax on the profits, but at a lower rate. How do you fund this? Well, you fund it by making a loan to your company. You provide the property, and then the company owes you back the money. So when the company receives rental income and pays corporation tax, it can then pay your loan back. So there's no tax on the money that comes back to you. And if you imagine you've only suffered 19% corporation tax, rather than you paying 47% tax on the rent, you're probably going to end up better off. The only reason not to do this, not the only reason, one major reason not to do that is if at some point you're going to need to sell that property. Because if you do that, you're going to sell it in the company, and the company will pay the equivalent of capital gains tax. And then you've got to get the money out of the company, so you'll end up paying more tax. But if it's going to be long-term for the benefit of the family, you can do that, and you can arrange the shares with different beneficiaries, children, grandchildren, having different classes of shares, what's commonly known as alphabet shares. Is this too good to be true? So this was an article in our Professional Institutes magazine, ICAW, Institute of Chartered Accountants England and Wales. It says why you should take care, but the conclusion was family investment companies are widely used and can be an effective solution for clients. Correctly structured, they are also tax efficient and unlikely to be viewed by HMRC as an aggressive planning technique. Just worth thinking about and worth having in your arsenal. Dividend tax. Again, increases of 2% for some taxpayers. So in the budget, they've increased the basic rates of tax on dividends from 8.75 to 10.75%, and an upper rate from 33.75 to 35.7. That's the 40% bit. Additional rate, the highest rate, it remains constant at 39.35%. Does this make having companies less useful than it did before? A little bit. I wanted to show you something which I have quoted before, but I think is really worth looking at. So this is about if you have a limited company and you're paying a spouse. And the wording here is, you'll see why I've been so careful with the wording. X is a GP. He owns all the shares in his company in which he practices as a GP. All the income in the company is earned by X, him. X transfers his shares to his spouse. X, the GP, earns £70,000. He takes a salary of £40,000 and he gives a dividend to his spouse of £30,000. Question, is the £30,000 his? Is it his spouse's? He's earned the money. He's given the dividends, the shares to his wife, his spouse, and she's earned £30,000. Now, I particularly use this wording because this is an example that's given by HMRC in their own internal manuals. So we know this what they think, and we know it's the advice that they give. And I've just highlighted the wording at the bottom there. It refers to a previous example. It says the property gifted here is a holding of ordinary shares with rights to capital. The gift from X, is not therefore property which is wholly or substantially a right to income. The settlements legislation, which is how they would stop this, does not apply, and we would not treat the dividend as the income of X. In other words, it is the income of the spouse. So this can work. You just need to make sure it's set up properly and the right class of shares is held by the right person. But again, would the increase in dividend tax mean that this is not a good idea? I don't think so. I think this is still worth considering. There was something else in the wording yesterday. They've changed the order in which you relieve your allowances. In other words, you can't say, okay, well, if my property tax is going to be taxed at 40, property income is taxed at 47%, I'll offset my personal allowance against that first. No, you can't do that. They're going to specify the order in which you can offset your allowances. And it says there, the allowance is deducted against employment, trading, or pension income first. So you can't manipulate the use of the tax bands. Capital gains tax. There wasn't much capital gains tax, really not at all, actually. Worth just referring back to this business asset disposal relief. You probably know it as entrepreneur relief. In the last Finance Act, the Chancellor increased the rate of tax from 10% to 14%, which it is now, and it goes up to 18% after the 6th of April 2026. So this is for selling business assets like surgeries, like your companies, like your private practice. Worth just mentioning that for capital gains tax purposes, the date of sale, date of disposal, is the date you exchange contracts, not the date you complete. So if you are thinking about a disposal of an asset in the next year or so, might be worth thinking about seeing if you can arrange the exchange of contracts before the 5th of April 2026 and complete after. Inheritance tax, there was only not much in there either about inheritance tax. There was something about the agricultural relief and business property relief in the last Finance Act, the last budget. You might remember that they restricted the allowances on agricultural property relief and business property relief to £1 million, caused a lot of unhappiness, especially around the farming community, including farmers who did commit suicide because they wanted to make sure that their assets were passed over before the new rules came into play. It's all very well raising the tax liabilities on things like farms, but actually the only way you're going to pay the tax is often to sell the farm, which defeats the whole point of having a farming community. So again, this isn't particularly relevant to our clients. Corporation tax. So they're going to double the penalty. You are getting the theme here, aren't you? They'll double the penalty related to register corporation tax from the 1st of April 26. There's a range of penalties depending on how late you are and how often you're late. Good news, they're going to extend the electric car 100% allowance by another year until March 2027. So this is, again, worth thinking about how this works. So if you're a GP, if you're a consultant and you have your own company, if your company provides you with an electric car, has to be new, has to be fully electric, not hybrid, provides you, then the company can claim 100% tax relief on the cost of the car against the company profits. It's not restricted by business use, as it would be if you bought this in your own name. The only other thing to bear in mind is you have to pay the benefit in kind tax by the fact that the company is providing you with an asset, with a car. But the tax rates on benefit in kinds for fully electric cars are cheap. They're good. You only pay 3% in 25-26. That's 3% of the cost of the car is the benefit, and it's the tax on that. And that's increasing by 1%, 2% until we get to 9% in 2029-30. If you had a Bentley, it would be 37%. So you can see the 3% is really good value. Worth thinking about, especially in the context of having limited companies. Capital allowances, this is the relief you get for assets that you're using in your practice, in your business. They're reducing the amount of allowance you can claim each year. It's currently 18% down to 14%, but there'll be a new first-year allowance of 40%, but not for cars and not for second-hand assets. Not that that matters really. So the national living wage, this is going up by 4.1% from next April, and actually by 8.5% for 18 to 20-year-olds. So for our clients, for our GP practices, and for other consultants who are employing people, this is an expensive increase in your costs. And you have to ask yourself, how does that work when the government is telling the DDRB they can only afford to pay 2.5%? The DDRB, by the way, is an independent body that makes up its own mind. So I'm not quite sure how effective it is or how appropriate it is to go into a negotiation saying, well, this is all I can afford. It's the DDRB will decide how much the increases should be. But this, I think, will have a not altogether good effect on GPs and consultants' profits. Electric vehicle excise duty, probably saw this as well, that you're going to be paying per mile with effect from April 28. Electric cars will pay 3p a mile, and hybrids will pay half of that, 1.5p per mile. I don't think there's anything else to say about that, really. If you've got a plug-in hybrid, I read this and thought, well, what's all this about? They said the government's going to introduce a temporary benefit in kind. So that's the benefit in kind what I was talking about with electric cars, where you have to pay tax on the benefit of being given an asset. So they're going to bring in a temporary benefit kind easement to prevent a significant increased tax charge from new emission standards. And actually, what I found out, which I've just pasted in below, is that there is a new European Union, the United Nations emission standards introduced, observe higher CO2 emissions for PHEVs than previous standards. So basically, they're going to ignore those new standards and make it easier, which is good. So we're half an hour in, and these are all the kind of serious issues that I've noticed in the 496 pages from this finance bill. And if there's any questions, I will be more than happy to try and answer them. Q&A. So let's have a look at some of these questions. If dividend tax is going up, is it worth having a company as a higher rate taxpayer? I think probably yes. It's still worth considering. And if you think about that example I gave, where we had the ex who gave the shares to the spouse, if you have a spouse who's a lower rate taxpayer or a non-taxpayer, then it's definitely going to be worth having that company. If you are an individual who needs a company and you are a higher rate taxpayer and no one else that you can give shares to is going to be anything else other than a higher rate taxpayer, and you need to pay all the dividends out, probably not. The other reason it's worth having a company, I suppose, is if you don't need to take the money out at all. So if you're earning more than you need and you can just leave the money in the company, you're only paying corporation tax on the profits that you're leaving in the company. Now, what people used to do is they would leave the money in the company and they would build it up, and then at some point in their career, they would liquidate their company, which means you kill it off, and the money you get back for your shares, and that's a capital gain. And with business asset disposal relief, even now, you're only paying 14% tax on the monies that you get back. Was 10%. Will it go back down again? I think if there's a change in administration, it probably will go back down again. There's always been a generous tax relief for entrepreneurs, for people doing business. It's now called business asset disposal relief. Before that, it was called entrepreneur relief. Before that, it was called retirement relief. So I think it probably is still worth having a company, depending on your circumstances. Next question. There's a lot of talk about pension salary sacrifice being a big issue. Will it affect NHS pension members? No, I don't think so. If national living wage is going up and pushing up staff costs, we don't know about global sum uplifts. What can practices do to prepare? Well, that's a very good question. And what do you do? Do you wait and see what the DDRB awards? You can't really do that. I think you just have to be conscious that the world we're living in and the society we're living in and the government that we have at the moment is not kind to GPs, and we just have to be vigilant, really. I think that's all I can really say about that. Not to follow with the capital gains on assets transferred. Could I elaborate? Yes. Yes. Let's supposing you've got a gain of £1,000 on your property that you're transferring into the company. So if the property's worth £1,000 and you put that into the company, then you now have shares worth £1,000. So when you get rid of your company, whatever you get for the shares, you would deduct the cost of shares of £1,000. But what you can do, let's suppose in the gain on your property of £1,000 was £500, you can roll that gain into the value of your shares. So actually, the shares that you have acquired in your company aren't worth £1,000 when you set the company up. They're only worth £500. So when you sell the company at some point in the future, you're only offsetting a cost of £500 against the cost of £1,000. It's a bit complicated, but that's the way it works. As a single parent and high tax, then is it worth having a company to reduce inheritance tax? To reduce inheritance tax, possibly not. It's probably worth having a company, potentially, if you can push some of your income into the company that would otherwise affect your ability to claim childcare allowances. So the £100,000 limit is a rigid allowance, and certainly I have clients who earn more than £100,000 but choose to put some of that income into a company through a separate vehicle. So it isn't their income, it's the company's income, and they're able to maintain their income at less than £100,000. Any more questions? Da, 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 da. Da, da, da. I think that's all the questions I can see here at the moment. I beg your pardon. I've just had some assistance from my colleague. Thank you, Hannah. Someone has a follow-up question. Could you explain the changes to VCTs and any pension tax relief? Apologies, was covered earlier. Changes to VCT. They've increased the limits for those trusts, VCTs, and enterprise investment schemes to qualify as VCTs and EISs, but they restricted the upfront tax relief. So instead of getting 30% tax relief on your contributions, it's been reduced to 20%. Pension tax relief, there was no change. In fact, the Chancellor made a point of saying there is no change to the tax-free lump sum. As I mentioned earlier in my introduction, I've been a partner looking after healthcare clients since I was 26. So you can imagine quite a few years ago now. And I think probably most years someone has told me they're going to start taxing pension lump sums. Well, they never have. So I don't think that's something that we need to be concerned about. Up, up, up. What's the one thing you should think people should take away from today's session? Good question. I think you should think about whether a company is something that is going to be useful. I know some accountants are quite anxious about using companies, but I'm not sure about that. I think that would be worth thinking about. I'm just reading all these questions. Can I compare and contrast? Goodness me. Family investment companies with trusts. Yes. So a family investment company, which we talked about before, typically the way it's set up is you have a company. It's just an ordinary company. You have your directors and your shareholders. The directors decide who benefits by getting the dividends, by voting the dividends to different classes of shareholders. It's quite straightforward in the way that works, and probably more popular than before than trusts. Trusts are more complicated. You have to have trustees who manage them. If you want to have the discretion about how you appoint your beneficiaries, how you appoint monies, then you need to have a discretionary trust. Discretionary trusts have what's called a 10-year charge based on the value of the trust every 10 years. There's a tax charge on the when monies get exited. It's a lot more complex, and it's something that really you need specialist advice about now. When does the tax relief actually reduce on the venture capital trusts? I'd have to check. I don't remember when that was. Someone has asked, is there a change in tax relief you can get towards spouses' pension contributions? So the question is, if you employ your spouse in some capacity, can you continue to get tax relief on the pension contributions? Yes, and there's no change to that. What's the limit, do you think? The limit will be whatever HMRC would deem to be wholly and exclusively in the performance of your business's activities. Typically, if you're paying your spouse a sum of money, then paying them pension contribution up to 100% of that will typically be allowed by HMRC. So it's a valuable relief because you get tax relief on the contribution, but your spouse doesn't have to pay tax on any of the value of the pension. How will the 3p EV be collected at the end of the year on tax returns? I don't know. I don't know how it's going to be collected. We'll see. Is it still beneficial to purchase an electric car given the paper miles, the new road tax charge? Potentially, yes. I think it is. What you have to weigh up, there's a number of things you need to weigh up. You need to weigh up the tax relief you'd get by buying the electric car, and whether that's through the company or through yourself. Remember, the 100% relief you get, which is talked about a lot, it's really an upfront tax relief. When you sell your car, so once you've had your 100% tax relief, then your car, for tax purposes, is worth nothing because it's had all the relief. So anything you sell your car for in the future is a profit, and you'd have to pay the tax back on that profit, whenever that might be. If you bought a car that depreciated very slowly for tax purposes, a really expensive car, and then you sold it in 5 years' time and made a huge loss, you'd get the tax relief on the huge loss in 5 years' time. So it's really a question of getting the tax relief earlier by buying the electric car. It doesn't actually save you tax in the long term. The numbers we're talking about, they're small numbers, the new road tax charge. I mean, especially, and that's really what I was making a bit of a fuss about with this mansion tax. They're big numbers. Most times you see a change in tax in a budget, they're small sums. We're increasing this, but by raising, it'll increase your family cost by £150 a year. This is £2,500 a year minimum, if your house is worth 2 million. Let's have a look, see what else we've got. I liquidated my company last year. Can I open a new company? Well, there's something called anti-phoenixism legislation that stops you doing that. So, um, again, it's technical. I'd have to check, but I think you have to wait 2 years before you would start a new company doing the same thing. Um, um, yeah. Can money be stored in such a company, then be invested in, for example, an index tracker? If so, once the company is dissolved, goodness me, in 15 years, will the capital be taxed at the entrepreneur's rate? Okay, so let's think about this. So if you put money into the company, money stored in the company, well, um, if the company earned this money, and so it was profits that were in the company, and the company invested that money, and then when the company would then be paying corporation tax on the income that was being derived from its money. And then in 15 years' time, if you dissolved it, then if it was a trading company and if everything stayed the same, you would benefit from the entrepreneur's relief. Indeed, you would, unless you turned your company into an investment company, in which case it wouldn't qualify for the what was called the entrepreneur's relief. Could it be beneficial to come out of the NHS pension scheme and invest in other instruments if my pot is full and I'm losing all my allowances because my NHS pension payment is very high? Well, we're not financial advisors, and we're very careful about talking about suggesting that people might be better by coming out of the NHS pension scheme. But when you say your pot is full, I wonder what you mean by that. There is no lifetime allowance anymore. You might be exposed to the annual allowance charge, but bear in mind that annual allowance charges can be covered by scheme pays. What some people do is they manage this by what they call I've heard it called the hokey cokey. You come in and out of the NHS pension scheme. So you might go in for 6 months, out for 6 months. If you're out of the pension scheme for a full year, remember you're exempt from the annual allowance charge, full tax year that is. So that's how some people would manage this. The NHS pension scheme is a very good scheme, and you'd be hard pushed to get the same advantages anywhere else. What are the disadvantages of buying the car from the company? Okay, what's the disadvantages? Disadvantages of buying it through the company are you're only getting tax relief at 19% and not your higher rate. So if you are able to claim that you're running your car for 60% business use, then you'd be better off buying it in your own name and claiming tax relief at 60% at 45% tax relief than you would do 100% at 19%. So you've just got to kind of think that through as to what would be the best way of doing it. Can you put your parents as new shareholders of your limited company and give them dividends? Can you put your parents as new shareholders of your limited company? You can do that. You can certainly put your parents as shareholders and give them dividends, and presumably there's no obligation on their part to give you back the money. They can be investors in your company. There's something that you just need to be aware of with all limited companies, and that's why we use that particular example. That the way HMRC can tackle this sort of arrangement is under what's called settlements legislation, whether you've inadvertently created a trust, and in fact you've still retained the value somehow. So it is technical, but in principle it should be possible to set that up in such a way. Is it expensive to extract the money out of the limited company from 26, 27? Dividends. Any alternatives? Well, you can take a salary out of the company. As a salary, you would just pay income tax on that. If the salary is more than £5,000, you'd have to pay employers' national insurance. So, but that's a good point. If you were going to take £5,000 out of the company, it would probably be better to take it as a salary now than it would be as a dividend. The dividend salary, remember, would qualify as an expense from the company, so you get corporation tax relief on that. I guess you'd have to look at the numbers and see if that worked out in your circumstances. The other alternative, of course, is not to take any money out of the company and just to leave the money in the company and just pay the corporation tax. Would you recommend a private SIP out of your limited company, even an NHS pension? I'm not going to answer that. That's far too investment related. So I think I'll just not recommend anything there. Is there a tax on giving them the shares? Was the limited company? Is there a tax on giving them the shares? No. There may be a tax on you potentially if you have reduced your if you've made a disposal of your wealth by allocating shares to your parents. So if you had a valuable company and you started giving away shares, you are making a disposal of your wealth, and that potentially could be liable to CGT. But if you set your company up from scratch when it has no value, and you set up your shareholders as you wanted to, including your parents, then there'd be no tax at that point. Would it be possible to challenge the mansion tax if you didn't believe your house was worth £2 million, what the council think it is? Well, these are all good questions, really. As I said, the valuation is going to be done by the valuation office. So that is a thing, a valuation office. As I said before, it's an executive branch of HMRC. They will determine what your house is worth. Will you be able to challenge it? I don't know. I don't know if it's going to be possible to challenge it. I expect not. How are we doing with questions? I think we're pretty much done with questions. I would like to thank everyone for coming along to this webinar. I hope that it was useful. I hope you managed to learn something that wasn't in all the headlines. I hope maybe it was worth listening to something that may be relevant to you as an individual. By all means, if you want to talk to us more about these issues, then you're welcome to contact us. And on the screen now, you've got our details. You've got my colleague Hannah, who has bravely sat with me and worked through this webinar. We've got our website, our phone number. I am your webinar host, and I'd like to thank you very much. And I hope you can enjoy the rest of your evening. Thank you very much.